Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. U.S. equity markets popped at the start of this week, a sign of hope for investors following a bleak trading week last week. After another soft jobs report last Friday, the focus is squarely back on growth. The JOLTS report shows that all of the excess labor demand from the pandemic has been corrected. So now the question is, does it stop here? Back on the show to shed light on this and much more is Director of Global Macro Jurrien Timmer. Jurrien reminds listeners and host Pamela Ritchie that market conditions have remained stable. He discusses the Federal Reserve's anticipated rate cuts, noting skepticism about the need for aggressive cuts, while emphasizing the shift in focus from inflation control to supporting economic growth. He addresses the debate over whether rate cuts indicate economic deterioration or a controlled slowdown, and of course references many historical examples. Jurrien also touches on broader market trends, such as the potential unwinding of the dominance of the Mag 7 tech stocks and the strengthening of other sectors, and he considers the impact of AI on productivity and economic growth. This podcast was recorded on September 9th, 2024.
You took a bit of a break, I hope. You deserved one. Of anyone, you deserved one. A lot of stuff happened in between, though. Are you shocked at how much has happened, actually, in a short period of time?
Yes, I was off the grid, not completely disconnected because I did have a Starlink at Burning Man, but disconnected from the markets for over 2 weeks. We had a really great burn. We fed about 6,000 to 7,000 people on the playa, which is the food camp that I run. It's what we do. So very proud of what we accomplished, and it was a good time as well. The weather gods approved for a change. But when I came back, around Labor Day, like the market had a few hits, and I come back and I'm reading, the papers and I'm talking to colleagues, and definitely was a sense of kind of gloom in the air. And so when I finally sat down to, update all my charts and do all the downloads last weekend, I was sort of expecting to see a lot of damage to the charts, and I actually did not see that. So I think for the most part, things are kind of where we left them off a few weeks ago, which is, this debate about, obviously we know the Fed is going to start cutting this month. They're going to meet on the 18th. Markets expecting some jumbo cuts, 50 basis points. I'm still skeptical that we will see that or that we need to see it. But clearly the narrative has switched from kind of the inflation side of the Fed's dual mandate to the growth side. And of course, we had the payroll report last Friday, the JOLTS report earlier. And to your point, if we go pull up slide 9, the excess sort of labor demand of the pandemic has been completely corrected. So that's that chart, the black line is sort of job openings as a percentage of the labor force. And as you point out, the big question now is, so if that line stopped falling here, the Fed would have achieved the perfect landing, right? And that justifies a return to a neutral policy. Neutral is probably around, 3.5, 4, my guess, with inflation 2.5 to 3. But, the pendulum rarely stops swinging until it gets to an extreme. And so the question is, will it actually stop here or will it keep coming down? And if it keeps coming down, we could be talking about either a significant slowdown or even a recession in 2025. And I think that's what the market is now grappling with, right? So the inflation battle, at least for now, seems to have been won with some good inflation reports in recent months. And now it's a question of the labor market and how solid is that. And I think that's what kind of the gloom is about right now. And that's why the market is now expecting more rate cuts even than it did a few weeks ago.
I mean, it certainly is. It's pricing them in, and I think you have some thoughts and notes on this. But I mean, the market's pricing in an awful lot of cuts. I wonder if they're all warranted. Let's go into the number and then maybe the pace, which goes to the 50 versus 25 discussion. Just your thoughts on that.
So slide 3 is my typical chart of well, it used to be the Fed funds curve. Now it's the SOFR curve, but the forward curve. And when we left off a few weeks ago, that the curve looked similar, but it's now even more curved, if you will,
Right.
with the market now expecting over 100 basis points just this year, which by definition means more than 25 basis points at a time because it's already
Right.
September. There's only so many meetings left in the year. And again, for the Fed, so on the one hand, I can see it, right? If the Fed is justified in cutting rates, and it clearly is, right? If we go to slide 5 for a moment, these are various iterations of the Taylor rule, and they're all moving very clearly in the same direction. And that's simply because the Taylor rule is based on the difference between expected between inflation and target inflation, and the difference between current joblessness or employment and kind of the target, if you will. And both of those metrics are moving, like the inflation one is moving in the right direction and the jobs one is moving in the wrong direction,
Right.
meaning the unemployment rate has been rising relative to kind of the natural state. And so clearly the Fed is justified in cutting rates. And there are some voices saying, well, maybe it waited too long to cut rates. And, if you're going to cut rates by 100 basis points or 200 basis points, why not just get it over with? And that's not really how the Fed does it unless there is a clear and present danger. And I don't think the Fed sees one. I don't really see one either. And just going back to slide 9 for just a brief moment, that drawdown in excess labor demand has happened while earnings have actually been accelerating.
Yeah,
And so
interesting.
it's not like earnings are falling off a cliff, and there's not, so to me, there is not an urgency. And so that brings me to slide 6, which is another way of showing what the market is pricing in from the Fed. That gray line is the neutral rate, which is a real rate, and it's currently around 1%, which makes sense. And the Fed is, of course, above that. The Fed is restrictive. Inflation is now sub 3%, and the Fed is at 5 3/8. Clearly, that kind of restrictive policy is no longer justified, A, because inflation is coming down, and B, because the jobless rate is going up. Um, but if you look at where the market expects the Fed to go, that's a pretty big set of cuts. And it's not quite a full easing cycle, but it's well beyond just returning or normalizing policy to neutral. So
Right.
maybe the market's slightly over its skis here, but it doesn't really matter because that kind of peak Fed will not occur till probably 2026, and by then, who knows where we are. So the forward curve is always a snapshot in time, and it's always changing. So for now, what we know is that the Fed's going to cut. It's going to cut by a couple of 100 basis points, and the data completely supports that.
And maybe they had to wait for the data to come or to sort of see the whites of the eyes of the labor story shifting. I don't know one way or the other, but go into the bullishness versus bearishness of cuts, because they can be read a couple of different ways. The soft landing sort of needs to stick if we see it as a bullish case. Take us there.
Yeah, so slide 4, I think there's generally a belief in the market that once the Fed is cutting rates, they're cutting them for a reason, which means that, which is that the economy is sort of falling apart. And sometimes that's certainly the case, but many other times, when the Fed is cutting rates outside of a soft landing, which we had with 1994, Greenspan, and a few other times. But oftentimes what happens, of course, is the economy overheats, the Fed raises rates, inflation is a problem, then it raises them too long, or it stays restrictive too long, and the economy goes into a slowdown or a recession. Then the Fed cuts rates, and usually by the time the Fed cuts rates, the damage has already been done in the economy and in the stock market, and then that rate cut provides the relief, lower cost of capital that the market can then rally on. And so more often than not, as you can see in this chart, the market does pretty well when the Fed is cutting rates, with the exception of those two lines that are going down, which was to the dot-com bursting in 2000 to 2002, and of course the financial crisis in 2007 to 2009. But other than those two instances, generally the market does pretty well. Maybe it goes down a bit first because it's still digesting whatever the weakness was before. So the market generally likes, lower rates, and especially in a soft landing scenario, which so far we are in. Um, and oftentimes, again, those rate cuts come after the pain has already been experienced in terms of earnings and the economy. And of course, this one is different because so far we haven't seen that, right? Earnings are actually rising and they're accelerating. Maybe the estimates for 2025 are too high, who knows? But the Fed is cutting rates or about to cut rates in an ongoing expansion, one that is slowing, which is by design. But it's a different backdrop from some of the worst case scenario Fed cuts that we've seen in the past.
It's something that some will argue in the equity markets is not reactive to the rate story, is the mega growers, the Mag 7 and so on. They just weren't interrupted by rate hikes. Maybe they aren't interrupted by rate cuts. We don't know. But there is a rotation going on that you've been talking about for weeks. We've all been watching for weeks. Tell us a little bit about that equity market story that arguably is not related to the rate story at all. There's a rotation there.
Yes, so let's pull up slide 15. And you're right. To me, this is the bigger story. So there's the fundamental story. Okay, economy, is it slowing? Are we going to have a recession? Is that inverted yield curve finally going to bite us? And is the Fed cutting rates too late or too soon? This or that. That's the fundamental story. And of course, that's always a challenge to figure out that puzzle. It's about earnings, it's about interest rates, about risk premia and valuation. But to me, there's a simpler, well, maybe not simpler, but there's a more technical thing going on that I think is going to provide more impact for the market than the fundamentals. Because so far the economy looks okay. The Fed, that rising rate pressure is about to end. A big chunk of the economy can breathe again, especially home buyers. But the dominance of the Mag 7, right, the mega growers, whether that's come to an end or not, or is coming to an end or not, nobody really knows in real time. But if it does come to an end, and certainly there's been hints of that in the last couple of months, then we have to figure out what that does to the overall market and what's happening underneath the surface. So in this chart, I showed the spread between the Mag 7 and the equal weighted S&P, and on a 3-month basis, that spread's gone from plus 28% to -9, which is quite a reversal. And again, as we've talked about in the past, when the big growers are so big that they completely dominate the tape, the headline indices, whatever they do is what the market is going to do. And so I think we're in a period where, and we can pull up slide 17, where there is some churn going on in the market, but it's happening in a handful of very large companies. So this is the top 10 S&P names versus the bottom 490. And you can see the top 10 are in some churn, right? I mean, those stocks are correcting, Nvidia, Apple, you name it. But the bottom 490, which again is 490 out of 500 stocks, are doing just fine, right? And this is the benefit of the Fed now about to lower the cost of capital. If you're a financial, like a bank, or if you're a REIT or a utility company or a consumer staple, all of a sudden that interest rate pressure is starting to ease off, and these companies can breathe again. And they are. So this is the broadening story that we've talked about so many times, right. But it's not necessarily a bullish broadening, because those mega seven stocks are so big that whatever they do, the S&P cap weighted index, the Nasdaq, the Dow, they're all going to follow. And so we may have a period that I think has already been in place since July and may very well continue into the fall, where the headline indices are going to be challenged, even though a lot more stocks are going up than down, right? And if we look at the monthly chart, which is slide 11, um, the monthly chart of the S&P 500 equal weighted index, I think that's a thing of beauty,
Pretty good
right?
looking there. Yeah.
That is a sustained uptrend, higher highs, higher lows. 80% of the stocks are above their 200-day moving average, which means that 80% of the market is in uptrends. And so that is what we need to keep an eye on. But again, for a typical index investor or a passive investor, um, that 80% that is now finally performing, that might get lost by the fact that a handful of stocks are dragging the index down. So even though the market is really healthy in that sense, uh, you may not, it may not, it may not produce a positive result for the headline indices unless you are, more actively managing your exposure by going down cap and broadening out. And so I think that kind of technical thing is maybe what we're going to be dealing with in the coming months, more so than the fundamentals of whether we have an expansion or a recession on our hands.
Fascinating. It's so fascinating. Okay, some great questions. There's a segue here to be made on this question coming in for you, Jurrien. Given the growth of AI and its potential to reduce demand for human labor, could this lead to deflation? And do you worry about this?
Um, I'm not an expert enough about AI to know whether it will lead to unemployment, reduce the demand for labor, but certainly it's going to be supposedly a productivity tool that will make labor more efficient, more productive, and that should very much be deflationary, right? So if you think about the speed limit for the economy, right, the potential growth rate of the economy, that is based on labor force growth and productivity growth. Now, the labor force is not growing very much because we have a demographic overhang, not only in the US and Canada, but in Europe, China, Japan, many parts of the developed world. But the productivity side, if AI delivers on its promise, which is to unleash a massive amount of capex, which then creates a massive amount of productivity, then that would raise the speed limit for the economy, which means that the economy can grow faster without producing inflation than it otherwise could. And so that would be a great thing. And that is, I think the great hope for AI is that it actually allows the US and other countries to maybe grow themselves out of debt, right? I mean,
Right.
one thing we haven't talked about today, but we've talked about in the past is the massive debt burden.
Sure.
And, demographically speaking, it seems hard to see how the world can outgrow its debt. But if productivity is on the rise because of the AI boom, then maybe that is one way, maybe not to outgrow the debt, but at least to keep up with it a little bit more and therefore make that debt cycle a little bit less unsustainable.
Yeah, that's so fascinating to deal with the government debt and deficits that so many countries are just sitting in and paying off at a very slow rate. Okay, another question. Is there a correlation between the length of the inversion and the depth of a potential recession? It was inverted for a long time.
Yes. Let's see. Let's go to slide 7. And so, yes, that inverted yield curve is now uninverting, which is interesting. So if you look at the 2s to 10s curve, here are 3 different iterations of it, but the 2s to 10s curve is now officially uninverted, and that comes after a very long period of curve inversion. And not only was the curve inverted for a long time, but it was inverted by a very large margin.
Right.
And again, there are things we can talk about in terms of, mitigating circumstances, the fact that banks, fund themselves on the deposit rate, which was only 0.5% rather than the Fed funds rate, which is 5 3/8, and the fact that homeowners and corporations termed out their debt, 4 years ago at extremely low rates. So there's all kinds of mitigating circumstances that may diminish the effect of the yield curve, both in terms of duration and magnitude. But nevertheless, we never want to dismiss an indicator that has been such a good indicator in the past. And if we look at slide 8, not to put a really scary chart on you, but we're equal opportunity analysts here. We got to look at all the data, whether it's good or bad. And if you look at the curve when it reached its peak inversion, meaning it went from being the most inverted to starting to become less inverted, which typically happens when short rates start to fall. You can see the stock market here, which is the black line, has never held up as long as it did after a disinversion, after a peak inversion, I should say, than it has now. And eventually the market, does go down because, again, historically speaking, the yield curve, when it's been inverted, has always predicted a recession, or almost always. I would put 1966 as an exception. And again, I don't mean to suggest the market's going to fall out of bed here, but we got to be honest. We got to look at all sides. And so now that the curve is uninverting, and the jobs market is slowing, we cannot dismiss the notion that maybe a recession does come next year. And again, even if it does, that doesn't mean it's going to be another financial crisis and the market goes down 50%. Like, I'm not suggesting anything like that. There are recessions and then there are recessions, but it's certainly one thing to consider. But I do think that the mitigating circumstances that I mentioned earlier have sort of taken some of the bite out of the yield curve, or at least has delayed their effectiveness, if you will. And now that the Fed is cutting rates, I think that's at least a good sign that whatever pressure the yield curve was putting on the economy, if it was putting pressure on it, is now going to start to dwindle. But again, I come back to the banks question. The banking sector is the lifeblood of the economy, and the banking sector, and typically when a curve is inverted, it tells you that the banks are upside down, right? I mean, they borrow short, they lend long, and if they're borrowing at a higher rate than they're lending, they're not going to lend, so you get a credit crunch, you get a recession. None of that has happened this time around because the banks are paying a deposit rate that's 1/10 of what the actual official rate is, and therefore their cost of funding has remained extremely easy this whole time.
Yeah, fascinating. So there's a great question about bonds coming in. We saw a pretty massive corporate debt issuance over the last little while. Treasury's issuance story has been going on for months now. So the question here is thoughts on fixed income. Does it still look as attractive for the long term?
So that's a good question. And if we go to slide 22. So the bond market ties into the expectations for the Fed, right? Because if you think about it, the 10-year yield is a series of forward curves, 1 year, 2 year, 3 year. And so whatever the market is expecting for the next couple of years is going to filter its way into the longer maturities. And then you have to add a term premium, and then you come up with essentially what the 10-year yield is. And so on the one hand, I think the market is maybe pricing in too many rate cuts, although it's kind of a moot point for now, and more of a question for 2025. But if you look at my bond model here, which is based on the forward curve and nominal GDP, based on the current forward curve, the bond market actually looks really cheap. It looks like we might go down to 3.5 or so on the 10-year, or even 3.25. But I think the market's probably a little bit ahead of itself in terms of how much the Fed will cut and how soon. So my guess is that the 10-year yield is, probably belongs at around 4% or so. So more or less where we are now. And then there's the question of the term premium, which you address by asking about the fiscal side. We are still in a period of fiscal dominance, right? And now we're about to get some Fed easing on top of that. So that reduces the cost of funding because interest rates are coming down. But still, we're going to have deficits no matter who wins or loses in November here. And so you still have to wonder about the term premium coming back for the bond market. So I think bonds remain sort of a coupon clipping market.
Interesting.
I think at 4.25, 3 3/4, it's all kind of in the same ballpark. But I think the bigger question is what roles bonds play. And it's interesting if we go to slide 1.
Oh, this fits well. There's a gold and a Bitcoin question coming in.
Okay,
So
all right,
perfect. That'll fit
quick
in there. Yeah.
Yeah, but if you look at the periodic table here, this is taking at rolling 3-month intervals. Long-term bonds are actually at the top for a change. They have not been there since 2020. So that does show that the diversification effects of owning bonds in a diversified portfolio, which did not work, of course, over the last couple of years, are working again. And that is a very that's a very hopeful sign that bonds have found their place back into a diversified portfolio.
Can we see gold and Bitcoin on there?
Yeah. Bitcoin is actually at the bottom, which is also not where it's used to being. But again, Bitcoin is a volatile asset. It's down 13% over the last year or so. So again, this is just a snapshot in time. But you look at gold, is near the top below long-term bonds. So interesting to see how these asset classes move around from quarter to quarter.
So what is the most sort of fundamental, I think you started off with that, but discussion right now? We're going to probably see the Fed cut. I mean, there aren't too many people who don't believe it will. But that said, the growth versus the labor story seems to be the balancing act. I mean, as you point out, earnings have really held up. Margins have held up. I don't know. I'm curious what you think that means for this important but maybe overdone focus on labor. I mean, do you think that's overdone? I don't know. What do you think?
Again, it's a question of that JOLTS chart that I showed earlier. The pendulum doesn't always stop in the middle. And so we're at the point where the inflationary excesses have been resolved, and that's why the market's not really focused on inflation anymore. And we're at the point where if the labor market weakens any further, then we're going to start worrying about growth and a recession. And there's a so-called SOM rule that if the jobless rate goes above so many tenths of a percent, that a recession has always followed, and we're kind of at that level. And again, that JOLTS chart on page 9, again, any further weakness brings it below zero, which generally gets you into a negative growth mode. And so the big takeaway from that is, can you have that happen at the same time that earnings are not only growing but accelerating? So we bring in slide 20 here. And that, I think, becomes the conundrum for 2025, right? In a way, they could coexist, right? So right now, the growth rate for earnings for 2024 is currently at an expected 9.5% growth rate, which is, of course, very nice. And for 2025, it's at 14.5%. Now, is that 14.5% too high if the economy is about to weaken further, at least from the jobs side? And in theory, you could say yes, because, right, if companies cut jobs, maybe it improves their margins. And so maybe those two things can coexist. But I think that becomes the question, right? As the narrative goes from inflation to growth, and it's happening at a time when earnings growth is is instead of decelerating, which you might expect to see when the labor market is weakening, instead it's accelerating. That will then become the main thing to get right over the next 6 to 12 months.
It's great to have you back, Jurrien. Thank you for setting us straight and setting up the Monday and the week of trade ahead. Hope you have a great week. See you soon.
Thank you.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on Twitter. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.